and welcome to the HFA and Meraki Global Advisors webinar on traditional hedge funds and crypto. I'm Ben Arnold, and I'll be moderating today's webinar. I'm the founder and CEO of Meraki Global Advisors, and we are a leading outsourced trading firm that delivers global multi-asset trading, leverage management, and capital introduction services to a diversified client base, which includes hedge funds, family offices, traditional asset managers, corporates, and private equity firms. I'm also the Southwest Regional Director of HFA. I would like to mention that HFA is a global nonprofit industry trade and nonpartisan organization with a mission to advance transparency, education, and trust in alternative investments. Membership in the HFA includes hedge funds, private equity, venture capital, real estate, and wealth management firms, institutional investors, family offices, and various service providers. Now, after our panel discussion, we'll open it up to audience questions via the GoToWebinar and in the GoToWebinar control panel, you'll see a box where you can type in any of your questions, which we'll monitor and try to address after the main discussion. So crypto and blockchain continue to pop up on all of our radars these days, most recently with the B-Word conference yesterday, where Elon Musk and Jack Dorsey, SEC Commissioner Hester Pierce, Kathy Wood of ARK Invest, along with a few other notable names from the crypto world, discussed possible ways in which institutions can incorporate Bitcoin into their system. Ethereum is also on course to settle over $8 trillion in value transfer on-chain by year-end, a staggering achievement. Today, we hope to cover a number of topics that will leave you with a sound understanding of how funds are actually trading in crypto and the various challenges and opportunities for institutional asset managers. Now let's meet our speakers. Jason Urban is the co-head of trading at Galaxy Digital. Galaxy Digital is a diversified financial services investment innovator in the digital asset, cryptocurrency, and blockchain technology sector. Our next speaker is Kevin Kang, and he's the founding principal of BKCoin Capital. BKCoin is at the forefront of the digital assets revolution and offers institutional investors an opportunity to capitalize on inefficient market conditions and gain exposures to the asset class through active and fully customizable strategies. And last but not least, we have Greg Bunn, who's the Chief Strategy Officer at CrossTower. CrossTower is a digital assets capital markets firm founded by financial industry veterans on a mission to bring digital asset trading and investing to institutional and professional traders. The firm first launched a multi-asset trading platform last year and has since expanded to include a capital markets desk with best-in-class services and products tailored to meet the needs of hedge funds, family offices, and other market participants. We appreciate everyone joining and our speakers' time today, so let's get started. Greg, CrossTower is a leading exchange in the crypto space. From your vantage point, what are the major costs and risks that institutional investors face when considering entering crypto markets?
Well, from a risk perspective, I would start by saying that we've come a really long way in terms of the space being fit for purpose for institutions. 3 years ago, I did a project for a large hedge fund that was looking at the space. And at the time, we just couldn't get past AML, KYC types of issues. So it was just a complete non-starter. Whereas today, pretty much all the friction points have been identified, if not fully worked out. So I don't feel there is a complete impediment to institutions entering the space because they can now analyze the risks and costs and weigh these against the returns they expect to generate. So the types of things that concern them, probably unsurprisingly, volatility, number one. You know, we've got an asset that's somewhere between 30,000 and 60,000 with 100 vol trading 24/7, 365. Illiquidity is another, you know, get outside of the top coins, top 10 coins, illiquidity becomes an issue, get out of the top 100, it's a bigger issue. I think we often hear from our clients other concerns, lack of clarity in the regulatory environment, certainly an issue. Custody is one, we're going to talk about that a little bit later on. Cybersecurity, and then finally reputational risk. And I think it's the last one that keeps a number of our institutional clients from jumping in. From a cost point of view, the types of costs in crypto are very much the same in nature as they are in traditional markets. It's things like execution, clearing, custody, and financing, except it is much more expensive in crypto. For example, on the financing side, the infrastructure is fragmented and disconnected from the wider banking system. So there's a big premium to fiat in the system, not as big as it was 2 months ago, but big nonetheless. From an execution point of view, liquidity is extremely fragmented. So you can find vastly different prices across various venues. And then finally, I would say there's friction in everything you do. It's fairly typical of a frontier market. But I would say for people getting into the space, rather than building huge models that are completely optimized, the best thing to do would be to test things in production, because there are many things that are priced on the screen that don't trade at that price.
Got it. Makes a lot of sense. And, I think we've had a bit of, in the current period, a lack of volatility and trading volumes a bit lower. So maybe people will have a little bit more time to focus on some of the more infrastructural points and thoughts that you've discussed and that we're going to discuss a bit further. Move on. Jason, your firm, Galaxy Digital, is a leading global full-service platform for institutions that are seeking to access the crypto economy. Do you think you can help our audience understand what are the current opportunities that hedge funds are missing out on by not entering the space? Seems like there's a bit of a FOMO aura around.
Well, institutionalization is a gradual process, right? It happens over time. People need to get comfortable with some of the issues that Greg mentioned, as well as, some of the things that we are going to discuss. So that FOMO, I think it gets people looking at things very aspirationally. But in terms of the trades, in terms of where we're going, I mean, it's clear that crypto is now an asset class. Crypto needs to be, you have to rethink that 60-40 portfolio mix and how people are doing things. So from a diversification standpoint, I think that's the number one area where people are missing, and maybe macro funds or long funds, it's definitely something there. In terms of people who are trading and trying to take advantage of different mispricings, there's everything from the basis trade to some of the arbitrage opportunities that have manifested themselves in some of the trust products and ETFs, as well as as you look farther down the spectrum into DeFi and truly the opportunity that DeFi presents itself. And so I think that you have to always weigh risk and reward. And so part of what I think everybody that's on this panel discusses with their respective clients is how to mitigate that risk, how to get access to those markets in a way that is thoughtful and is not going to be a career killer. It's certainly, crypto is not it's been de-risked to a large degree. Maybe it's not the same as being a bond trader, but to the extent of where it was 3-4 years ago to today, it's certainly a different landscape, and the opportunities are still, it's ever evolving, and so the opportunities are there all the time.
Yeah, it certainly is. I think with the NFT volumes at all-time highs and DeFi becoming more and more established and being recognized by legacy finance investors, we're seeing a little bit of a shift here in comfortability and arguably, I guess, more sophistication. So as I think we continue to see and have seen in all asset classes. Kevin, as a CIO of a successful crypto hedge fund, BKCoin, can you shed some light on how hedge funds currently invest in the crypto space and what you see as the main challenges?
Sure. There are multiple ways to get into the space. The last 3 years, the infrastructure has developed tremendously. This new digital asset class basically has adopted traditional asset classes infrastructure, right? But we still have a long way to go. We're still lacking of good prime brokerage solutions. But in terms of custody solutions, we've come a long way, and now it's institutional grade. And some of the hedge funds invest in, whether it be Grayscale Trust, they can invest through ETF in Canada, Latin America, or ETPs products in Europe. The way we're looking at this space is everyone on our team comes from traditional. So we really want to bring institutional grade strategies as well as compliance and risk management to this new asset class. And we're taking a very active approach. Rather than buying and hold, we run multiple different strategies. Our flagship strategy being market neutral strategy, meaning we focus on mispricing in the market, just because this asset class is so nascent. There are a lot of mispricing in the market, as well as a lot of arbitrage. So As Jason mentioned, basis trading, one of the popular trades the last 12 months, even though basis has completely collapsed the last 2 months. And some of the main challenges is the lack of regulation, right? Or at least the regulatory clarity here in the US. I would say Singapore, for instance, is way ahead of us for now, but there are a lot of groups out there that are working with regulators here in the US, as well as lawmakers here. So I'm optimistic that US will come out on top of it.
Interesting. Got it. All right, I'm going to ask all the panelists, as the crypto markets continue to institutionalize, what do you guys see as the main challenges for traditional asset managers that are beginning to invest in the space?
Yeah, I'll start off by saying the crypto market is still very small relatively compared to traditional markets. So let's say, for instance, when the bear market in crypto can make it very hard for institutions to invest due to illiquidity, right? But also DeFi space has grown tremendously the last 12 months. But a lack of KYC AML checks in the DeFi space is going to continue to make it very difficult for traditional institutions to capitalize on this nascent asset class without investing through another counterparties, so they can seek exposure through whether it be grayscale products or bitwise products, etc. But yeah, I see that as a main challenge, like with KYC AML checks in the DeFi space.
Any Greg or Jason, anything to add?
Yeah, absolutely. One of the things that I'd want to add to that is I think education and getting comfortable is really important right now. If you think about, we've all at some point were new to crypto. It didn't just happen day one. This isn't like this is an asset that you grew up as a farmer or a miner. Like this is innovation. This is the cutting edge. And so getting kind of into the flow is important, and understanding that education process is so key, and getting a comfort level that will allow you to address the issues. We get a lot of inbounds from traditional hedge funds, from traditional asset managers who are asking questions that it's not a giant mystery. It feels like a mystery because when you're looking at it from the outside, it's like, God, how does custody work? What does not your keys, not your coin mean? What do these things mean? When the reality is, it's the same methodologies and the same things that we've all done for all of our careers. No different than you keeping your stock portfolio, your bond portfolio somewhere. It's the same thing. There's just a little different way that it works behind the scenes, but that can be explained. And a lot of the checks, and when I mentioned previously that we've been de-risked, a lot of those things, the early days where you were hearing about hacks and you were hearing about a lot of nefarious things, a lot of that happens in every asset. Bernie Madoff had a Ponzi scheme, right? So bad things happen, but the reality is almost all of the issues that people hear about or think about are no longer really, they've been addressed and solved for. And now it's the next generation and the next iteration of process that we're going through.
I'll add one more thing there. I think those are both really good points. I think data is another issue. Encountered a number of institutional clients just thinking about how to build out a strategy in the space. If you look at Bitcoin in particular, from a portfolio construction point of view, over any time horizon, portfolio theory will tell you that it has a place in the portfolio. And that's largely because the returns over most periods have been very good, notwithstanding the volatility. But actually thinking about how to parlay that into some sort of active management portfolio, there isn't really enough data to be able to do that conclusively.
Got it. Do you guys have any recommendations for the audience of various resources that they can utilize or look for on the internet, or do you guys have anything published that they can find answers to more of these types of questions? Because as we know, in these markets, everything's rather opaque.
Yeah, absolutely. I think that one of the things that Galaxy that we do well as a firm is education. We have an active research team. They produce excellent content addressing everything from ESG concerns to the latest news, whether it's a mining ban in China or the B word conference and things of that nature, as well as regulatory and other, pertinent issues. And so, I think it's firms like ours and the people on here who are the resources. We're more than happy. It's kind of in a way, it's our job to educate and to bring more people in, because a rising tide lifts all boats. And so I think you'll find most people that are in the crypto space are willing to engage in conversations and discuss, how to make it a part of your portfolio, whether it's an active piece, a passive piece. We're all here to help.
I'd add we produce a lot of content at CrossTower as well, and anybody can sign up to get it, and we put a lot of focus on really good thought pieces.
Yeah,
Great.
I would say the beauty of this space is that everyone's working together to grow this space. So as Jason and Greg mentioned, I really enjoy both of their research on a regular basis from both CrossTower and Galaxy. We also publish monthly commentaries on the website as well, so there are tons of resources out there.
All right, good to know. It seems that it's becoming more plentiful. I certainly get more emails about it. Jason, getting down a bit into the weeds here, how are hedge funds executing their trading? And Kevin spoke a little bit about liquidity. Are there large-sized institutional blocks available and or desks available for risk pricing in digital assets?
Yeah, absolutely. A lot of what you see in crypto mirrors what in the traditional world, right? And so, as Greg mentioned before, there's times where the price on the screen is not necessarily the price that adequately amounts to the risk. And that's one of the things that Galaxy, we like to think of ourselves as the bottom of the risk funnel, because we are public, because we are transparent in what we're holding, and people know the risk that we can warehouse. And so from that standpoint, yes, there are block trades and there are large institutions that come in, and we work with them on the best ways to manifest their thoughts, right, and execute in the market. And so, to that end, yes, it's out there. I think that you're going to find at times in products there are liquidity gaps. The pricing that I'll quote, on a lazy day is a lot different than you would quote on a market that's rallying hard or selling off hard, just as you would in any other asset class.
Would there be any? Would you be able to put a number to what we see in other asset classes for like a social clip size on a lazy day? Is it $1 million?
Yeah, I
Is
mean,
it 10?
I would say 5 is probably, and it also depends on the asset, right? If you want to talk about, pricing impact, Bitcoin versus pricing impact on some smaller chain or protocol, you're definitely asset specific, and it very much follows the market cap. So you're going to get much more liquidity in Bitcoin than Ethereum, and then as you kind of work your way down, you start to see the impacts and the timing too, right? And it is a 24/7 market, and so there are times while everybody trades following the sun. I know that we certainly do. You do hit times where it's a handover between the U.S. and Asia, or Asia and Europe, and that's not just unique to us or anyone else. It's unique industry wide. And so there are times where I would tell a client, you do not want to try to bang this thing out, 5 o'clock on a Friday Eastern time, right? Like wait till the Asian team is on board in 3 or 4 hours. You're better off executing then, depending on your time horizon.
That makes sense. Greg, I think the next question to that would be, all right, so how do I get in this? So how does custody and prime offerings in crypto work?
So custody is a vast topic. You essentially have 6 different ways to custody, but I guess from an institutional perspective, having a ledger locked in a vault in Switzerland probably isn't going to work. So I'll focus my comments on third-party institutional custody. And it's going to sound quite strange when I say that institutional custody solutions in crypto are not that different from traditional markets. There is a bunch of extra complexity and it does price higher. But we've seen the emergence of some really high quality crypto native custodians who have really deep knowledge around the software engineering and security aspects that pertain to crypto. And then layer on top of that a bunch of traditional services that you'd find with any custodian in the traditional markets. So if you think about what institutions expect from a custodian, it's really keeping assets secure. Obviously, that's the core of it, but also servicing assets. So, voting on behalf of the beneficial owner, collecting dividends, maybe using as part of a lending program, servicing corporate actions, and so on. And you have pretty much the same thing in digital assets, where you have a regulated custodian who holds your assets in cold storage, and then provides the ability to utilize those assets, for example, for voting on protocols, utilizing lending, staking, and so on. So there are definite parallels there. On the prime side, it's more complicated, because prime means different things to different people. So even in the traditional space, there's a distinction between a fixed income person or an FX person talking about prime, which is more sort of execution and clearing related, and an equities person talking about prime, which tends to be more, it's a bunch of things, but it tends to be more focused on the financing side of things. So in essence, prime is a huge spectrum of activities, and in crypto you can find most of them, just not in the same place, which kind of defeats the whole prime, the whole purpose of being a prime. So I would say on the execution side, there've been really good developments in dealing with fragmented liquidity in a way that delivers something approaching best execution, or at least would allow you to satisfy best execution requirements. So, smart order routing, liquidity pooling, and so on. On the financing side, there have been some good developments. I mean, there's a pretty good and active borrow lend market. We see total return swap type products, and the sort of nascent development of traditional refinancing tools like repo. And we've seen the expansion of some other traditional PB stuff, like sort of high touch white glove services, and even heard some talk about cap intro. But I think what we're lacking at this point is standardization. The main thing about PB and other securities financing arrangements, repo, Delta One derivatives, and so on, is that they're highly standardized. And so, PBs compete on spreads, infrastructure, risk management, but the market structure and the documentation and so on is very much standardized. And what this allows funds to do is to trade and finance seamlessly across multiple products with multiple counterparties and on multiple venues. So we don't have anything like that in this space, and that leads on to other things like cross-margining of portfolios. I'm pretty clear that that is the direction of travel, but it's going to take us some time to get there.
Got it. Kevin, anything you'd like to add in those execution, or, I mean, you've been through the custody and prime offerings, so maybe you have some insight.
Yeah, sure. There are a lot of big firms out there, such as Galaxy, trying to come up with prime brokerage solutions. And the last time we spoke with them, they're going to be launching pretty soon in the coming months, which we're really excited about. As Greg mentioned, cross-margining is a big thing that's lacking at the moment. So for us to trade futures or options, we have to manage our collateral across many different exchanges. But once there's a real prime brokerage solutions out there, parking our assets with our prime broker and routing our trades through our prime broker will be a lot more efficient.
Got it. And then, Greg, I wanted to ask you, with that in mind and trading that you touched on, can you provide some color on any major technology issues that are currently being faced, as well as touch on the exchange reliability as it relates to these issues? Because we have seen, in the past where Coinbase went down, et cetera, how that comes into play.
Yeah, I'd say the biggest issue in technology is just the shortage of bandwidth. Like, all problems are solvable, but things are moving so rapidly that it's really difficult to get ahead of these things. And so, we're seeing a lot of things that need to get solved improving, but it's the old analogy of trying to change the tires while you're traveling along the motorway at 150 miles an hour. So, to the point about exchange reliability, it certainly is a challenge. The evolution of crypto was, of course, driven primarily by retail. So most of the infrastructure is built for purpose, of the early functionality or the early demands, web-based and so on. And so, it often results in periods of instability when we have high volatility. And yeah, sometimes exchanges go down, and sometimes they go down for quite long periods. And I think that's partly why a lot of the institutional business these days takes place via OTC desks rather than on exchange. The approach we've taken is that as institutions trade more on exchange, they're going to want to have an experience that they're used to from traditional markets. So our approach has been to build a high frequency, low latency, high throughput tech stack. We offer colo in LD4. We very much see that as the direction of travel for institutional product in this space.
And to build on that a little bit, Greg, you're spot on in terms of saying that a lot of this infrastructure and this ecosystem was built for a different purpose. I mean, some of these things weren't even built to be exchanges, and they pivoted to crypto at an early stage. And so a lot of that, development that you would see, it didn't take place or is now getting, backfilled. And so, to Kevin's earlier point about Prime and access, I think that that's one of the things that everyone is trying to build. I know that we're rolling out ours, as Kevin said, in beta now and, full offering in Q4 is, you're trying to connect, some of them are WebSocket, some of them are REST API, some of them are fixed API, and you want to deal on the best, but you also want to go where liquidity is. And so you have to find solutions that are kind of, in between. And that's really the challenge. It's the challenge of dealing with a bearer asset in a universe where we're still fixing or reworking some of the things that we've done.
Yeah.
Got it. All right, shifting gears slightly. Outsourced trading, it's certainly in vogue these days. I think I get a Google alert almost daily. I'd like to ask all of you guys if do you see a role for outsourced trading firms like Meraki Global Advisors in the crypto space?
Yeah, I can hit that one first. I definitely think there is. I think that one of the beautiful things about crypto is that there is a lot of parallels, and it's very, history doesn't repeat itself, but it rhymes. And so the same, a lot of the same things that we're doing in crypto, maybe the technological solution is different, but the actual, end result is the same. And so to that end, as we develop and as this becomes, more standardized and things become easier to manage, that's certainly the case. I think that up until now, people who have solved that equation have tended, like Kevin, who have tended to keep it to themselves, right? Like, that there's more viability in that than there is, in a different way. And so I do think that there's opportunity there, and I think that the smartest people in the space are going to figure it out.
Yeah, I'd add to that and say it's a market that probably lends itself to that in many ways because it is a frontier market. And to the point that I mentioned and Jason echoed, many times you're not able to trade on the screen, so you really need to leverage that expertise. You need a good feel for these markets.
Yeah, it's a very fragmented market. A lot of firms are out there working together to make sure the market becomes more efficient, but I think there's definitely space for.
Sorry, Kevin, we're having a little bit of trouble hearing you. I think your microphone might have gotten down a little bit.
Sorry, what I was saying was I think there's definitely room for outsourced trading firms to be in the space, because if you're a smaller traditional allocator looking to get into the space, do you really want to open up an account with 5 different OTC brokers or 5 different exchange accounts? I think by going to outsourced trading firms, I think it will save a lot of headaches.
Got it. No, that makes a lot of sense. And it's similar thing to what we've seen, and we've discussed with people about helping them trade crypto. And it's probably not, for most market participants, their number one asset that they're trading. So if it's not a huge focus, then trying to find experts in that, or we see the same thing with rates trading, trying to find trading experts in those nuanced asset classes saves a lot of bandwidth and can be very helpful. So I think it's kind of continuing theme that, like Greg pointed out with frontier type space. Got it. So Jason, we're going to ask you, as more entrants enter the space, Do you think we'll see the crypto markets evolve, and what does that mean for the
Oh.
traditional market participants? Like the brokers and the prime brokers and the traditional ones. What are they doing?
Yeah, absolutely. And I think that you look at, you can look at point to DeFi right off the bat and say we're already, in version 3.0 or whatever. There's one constant in crypto, it's change, and it's evolution and it's improvement. I mean, when you think about the pure minds that are working in this space, the best developers and engineers and thought leaders, and you think about that relative to any other company on the planet, Apple, Google, it doesn't matter. There are more people trying to solve problems in this space. And so, as you think about that, one, the people like us that are on the call that are kind of leading the front, the bleeding edge of that, we're going to expand there, and that will make it safer for more traditional folks to flow in, whether it's prime brokers. We see it now with a lot of banks who are now, actively engaging and trying to find ways to transact here. And so, we all are constantly faced with the need to evolve. And I think that you're just going to see that as we evolve on the bleeding edge, you're going to see the traditional guys step in and fill those next voids as problems are solved and solutions are created.
And that kind of points us to, as problems are solved, solutions are created, more and more regulation. So, Greg, on topic there, the Basel Committee on Banking Supervision, they recently published a public consultation paper on how banks will be required to allocate capital on cryptocurrency positions, loans, and other exposures. So, do you think you could briefly summarize the proposal and discuss some of the major potential impacts?
Yeah, you can't escape the Basel Committee, right? Yeah, so I recently wrote a note on this. So essentially, the Basel Committee is a global body that really determines the principles for how risk-based capital and leverage-based capital should be allocated against positions, and then the local regulators take that broad framework and develop that into local banking regulations. And essentially what the paper does, it's a consultation, it's open until September. So we are working with industry groups to provide our feedback on that. But what it does is it divides crypto into two categories. The first being stable, non-volatile currencies, they call them, essentially stable coins, and the second being what they call group 2, which is volatile currencies, which is essentially everything other than stable coins. And the capital allocation regime is that you need to risk weight positions in volatile currencies at 1,250%. That effectively equates to a capital deduction for a bank. There's almost nothing that is a capital deduction for a bank other than a large holding in another financial services company. So you can see that's very, very punitive. I'm not surprised, given the asset is a 100 vol, 100 plus vol, or the main asset is, and the Basel Committee have been kind of leaning this way and suggesting that this is the type of treatment that they're likely to land on. But it is going to be very punitive for banks to hold crypto on balance sheet or to use it as collateral for lending. Then the other interesting piece is this is the first paper that the committee has looked more closely at stablecoins. And whilst the general regime for dealing with stablecoins is on a look-through basis to the underlying, there is a caveat that says that if the crypto coin or the stablecoin fails to maintain its peg to within 10 basis points on more than 3 occasions in a year, it is deemed to be group 2, i.e. it's deemed to be a volatile cryptocurrency. And I can tell you, when we went through that period in May recently, I don't believe that any stable coin traded within 10 basis points of its peg. And therefore, the implication is that at this stage, we would consider that they'll fall into that volatile category as well and attract this very punitive treatment. There's a long way to go on this. As I say, it's a consultation paper. The industry is organizing around it. But often with these Basel proposals, the final results don't deviate much from the general principles that they put out for consultation.
Got it. All right, so a little bit more granular here. Give you gentlemen a chance to let us know how you're best suited and are suited to help some of our some of our attendees here. Kevin, start with you, and your fund offers 5 main strategies. Can you provide some insight into how you manage the market neutral and DeFi strategies, and what products you're currently closed or offering to investors?
Sure. All our funds are still open for subscription. We're always trying to grow as much as possible. For instance, to give you guys an example of a market neutral strategy, we're focusing on arbitrage opportunities. In the beginning, back in 2018 when we first launched, we focused on inter-exchange arbitrage, currency pair trades, such as triangular currency pair trades, which is a classic FX trade, right? But as more sophisticated investors started coming to the space, that those hours are now slim to none. So the last 12 months or so, a lot of our alpha came from future spot basis trades, but instead of holding onto that positions, we're actively going in and out of positions as those bases fluctuated. Try to gain around 10 basis points a day, compounded over the course of the month, try to gain high single digits month after month, right? But the last 2 months, the basis has completely collapsed, so we've been finding a lot of mispricing opportunities in the options market. We brought on the head of the fund earlier this year, who has really good background on the options market. So we've been deploying some of our capital in the options market. With the DeFi strategy, we're deploying the fundamental analysis from traditional markets. So the beauty of the DeFi market is that when you were to invest in certain protocols, you can see their revenue being generated in lifetimes. Whereas if you're investing in equities, you got to wait till their quarterly earnings, and those information's not so transparent. But in the DeFi space, you can see how much assets being locked on certain protocols, how much revenue is generating. So we can really adopt bottom-up analysis to the DeFi space, come up with PE ratios, price to sales ratio, etc. So we're adopting that traditional valuation models into DeFi fund and try to really capitalize on the growth in the DeFi space. And we also offer Bitcoin Smart Beta and Ethereum Smart Beta strategies, which are to accumulate more Bitcoin and Ethereum. And those strategies have been super popular among family office clients who want to hedge their US dollar exposure against potential devaluation or inflation. So they just want to accumulate more Bitcoin or Ethereum as a store of value. So those returns are denominated in Bitcoin and Ethereum terms, and those strategies are more directional. We deploy a combination of momentum, trend following, and mean reversion strategies, and we're now starting next month overlay that with option strategies as well.
Got it. Interesting. Jason, you want to give us a little bit of a brief about some of the products that you guys offer and at Galaxy Digital?
Absolutely. If you think about Galaxy, we truly try to touch every aspect of the crypto universe, and it's everything from asset management and some of the fund work that we're doing with like CI and the Galaxy Fund up in Canada, the ETFs, as well as things like that. But where I tend to focus is on the trading and execution side, and from that standpoint, we give people access to over 30 exchanges. We trade a wide variety of derivatives products. I know that we've talked with everyone that's on this call at some point in that space. And given the fact that we are kind of the bottom of that risk funnel, we tend to really transact there. We have a robust lending business. It's so important in an asset class where it is a bearer asset, and in order to be on multiple exchanges to take advantage of mispricings, you have to actually have physical asset there. And so we do have a pretty robust lending business. And so we try to touch every aspect. We offer clients both electronic access as well as block access, and then obviously the derivative space and the lending book. And that's in addition to things like staking and other next gen things that we offer, maybe some of the more crypto savvy clientele. So depending on, we have a product for somebody who's just starting to enter the space, but also a little farther along, and we try to serve both segments of the space that way. And in addition to that, then we have a variety of funds that allow investors to get access to the market, if they just want to buy and hold or want access to new innovative things with our Galaxy IP, as well as things we're doing in the NFT space with Candy, et cetera. So we really try to have a full, well-rounded offering so that when clients show up, we can be their one-stop shop, and we can also be an educator and say, hey, you like this, have you thought about that? And basically try to shepherd them into things that might be more appropriate for what their risk tolerance is, one way or the other.
Got it. And Greg?
Yeah, so from our perspective, a few things. I think on the execution side, we have 2 exchanges, one in the US for US customers, one in Bermuda for international customers. And, to the point I mentioned earlier, this is a, high frequency, low latency, high throughput platform, tight spreads, low fees. We're actually, we're going with that model that's where the market ends up. So let's go straight there. We have also launched, we are launching a futures product, and we're building out an options product on our offshore exchange as well. We have a financing business where we do a range of financing things. I'd say we're pretty flexible in terms of what we can do. So we do a lot of bespoke type structuring. So that's a second area. And then the third one is on the investment product side. We don't do any active management, but we do provide vanilla directional exposure to Bitcoin and some structured products where people are looking for example, downside protection with some upside participation or some sort of yield enhanced type products.
Got it. So it seems like between the 3 of you gentlemen, there's a full gambit of opportunities here. I guess I'd ask each of you briefly if you had 1 or 2 areas that you felt are the most most exciting in your respective areas of expertise coming in the next 6 to 12 months.
Yeah, I wanna start off by saying the growing institutional adoption, right? So we've seen a lot of institutional investors dipping their toes into the space the last 12 months or so, but I think we're still in the very early innings of it. When you look at the high yield corporate bond yields, the spread is coming in at close to 20-year lows. So this pension funds and other traditional allocators are really going out of their risk curve, trying to find alpha in the market. And I think digital assets can really offer some of the better returns than you see in the traditional markets. And they're going to be first mover advantage, right? So let's say big sovereign wealth funds and all the pension funds start allocating in this space, the alpha will definitely come down. But the earlier they move in, they're going to be able to capitalize on the growth of the space, whether it be through Bitcoin or through active strategies or through DeFi strategies. So that's something that we're really excited about.
Yeah, for me, it's DeFi. I think the innovation that is happening in that space is incredible, and I think is going to change the way traditional finance does a lot of things. Having run a prime business, I wasn't always sure that liquidity transformation had to take place via a bank balance sheet, and in this solution, it isn't. You have a proper segregation of roles between credit creation and record keeping that I think is going to be very impactful. There are clearly risks. In the first instance, there's KYC AML, although that is somewhat being addressed with permission pools, and there are clearly liquidity risks. But there is also some innovative thinking around how to address those, and we've been involved in working on some of those things, which I think is just incredibly interesting.
Yeah, I would echo Greg's statement on DeFi. I mean, I'm out here, as we were talking earlier, at the Paris Ethereum conference, and talking to some of the smartest minds in the space and what they're working on and how they're trying to address a lot of these problems or opportunities, if you will, in the space. I think that's really going to be, it's going to change the way finance is done. We talk about how the internet changed retail. Blockchain is going to change financial services. And, to that extent, what's happening is so exciting. I do think, things like AML, KYC and how you interact with DeFi is important. And, so I think that we all have to be cognizant of regulation. But to that end, I welcome it. We welcome it as a firm because it gives us a set of rules. I think that uncertainty has made it difficult, for traditional institutions to step in because they're not as far out on that risk curve. And so I think that that's going to be a great opportunity. I think it's gotten to the point now where regulators know they have to address it. They will create a set of rules, and we'll all play by those rules, and that'll make it a lot better for the institutional adoption. So I think it kind of will touch on all those aspects, everything from DeFi to, to institutional adoption in the space.
Great. Yeah, look, I think we covered, we were able to cover quite a bit of ground, and answered, I think we gave everybody a lot of information. I think we have a few more minutes of time left, and I think it'd be great. There's a few questions that are rolling in that you guys have touched upon, actually, that I'd like to ask, and anyone, of the speakers, feel free to address it. We have one question about how, addressing how the KYC and AML can be assured given the anonymous nature of the asset, especially in those OTC trades. So Greg, I think this is something you had alluded to, that there is some works in progress here.
Yeah, I think in particular what I was talking about is in the DeFi space, because that's the key area where people are interacting with one another directly, right? And so the key thing there is that is the evolution of permission pools, where people will be KYC'd before they go into those pools, so you have certainty that you're not dealing with a bad actor. Now, it remains to be seen where the liquidity is going to go. And I think what's quite interesting in terms of risk premia is that we're starting to sort of, initially when you look at DeFi and you see these huge yields, you go, how does this work? This is kind of impossible. But if you start to disaggregate it into its various component risks that you're taking, risk to the protocol, risk to the smart contract, risk to the sponsor of the stable coin if there is one involved, and so on, you can start to figure out what the risk premium is. And I think what you end up with is some sort of differential between a permission pool and an unpermissioned pool that is the risk premium to the KYC element of it.
Got it.
Yeah, I think the one addition I would make to that is in terms of traditional OTC and the way things are done, that those problems have been solved. You're whitelisting wallets, you're whitelisting addresses. You can look at provenance of coin. There are a variety of ways to address that, and these are some of the problems that have been addressed over the last 3 to 4 years that I discussed earlier, where a lot of that risk in the space, just getting into the asset class, has been de-risked. As you move to that bleeding edge that Greg talked about with DeFi, you do have to be concerned with some of that.
Right. I mean, I don't know, but I would assume, KYC AML follows a pretty standard protocol of the things that you need to address and work on before you have, these particular clients. So I would assume it follows a similar standard, and you're doing the same sort of checks. But as you mentioned,
it's even more robust than that. You're doing the same checks, but you're taking it one step further, right? Things that you would do, and we get clients that bristle sometimes at how extensive our onboarding process is. But that's, we've made it as smooth as possible, but we're doing that to both protect the clients as well as protect ourselves. And so it's just being thoughtful, in a global view, 180 degrees.
I would say it's more difficult to open a crypto account, at least certainly with the regulated players, than it is to open a regular bank account.
Yep. Got it. All right. Little switch here. We got a question, not as specific, but I'll try and make it a little bit more specific. Do any of you have any thoughts or tell us a bit more about how you think about or to look at? We see it all in the news and what's going on with crypto mining that may be insightful.
Mining is fascinating. I was going to put that next after DeFi. I think what is going on is obviously the China crackdown is a major driver of what's happening, and you're having the big miners trying to ship themselves out of China into more crypto-friendly places, and so the US being one of those. So there is just a huge surge in trying to tie down facilities, trying to tie down electricity supply, trying to get machines installed, and then a huge demand for financing around that. I think some of the economics is pretty fascinating. You know, we've seen with some of the bigger companies and in process a SPAC that's coming to market, which is quite an interesting dynamic in terms of capital spend, and then even at pretty conservative assumptions around Bitcoin. You know, what the revenue projections can be there, and what the corresponding valuations can be there. So yeah, very interesting stuff going on in mining.
Yeah,
I mean, miners are the backbone. Oh, go ahead, Kevin.
yeah, I just wanted to add, the mining space is getting more interesting as China cracks down. I think it'll be a win-win for everyone, especially here in the US, because the mining world, it went from semiconductor being constrained to now infrastructure constrained. So there are a lot of development here in the US, try to get a lot of miners out of China here in the US. And it's going to bring more transparency and clean energy to the space.
Yeah, I would echo that. You know, the only thing I was going to add is they're the backbone of the industry. And so because of that, what affects them affects all of us. That is what keeps that decentralized ledger working. And so, you know, it's important to have an understanding of the mining, you know, capabilities of the ecosystem as a whole, what things are affecting them, because ultimately that has a trickle-down effect. They are the true commercial in the space, right? So if you think about the farmer is the commercial in, you know, the wheat and corn business. Well, they are the commercial in our industry.
Yeah, and as we've seen, you know, markets become efficient. It takes time, and you know, I was surprised to see when we saw the drops in Bitcoin based off of news of China saying they're, you know, probably not going to allow Bitcoin anymore. But I was surprised because it shouldn't have come as such a shock to everyone that, you know, China has the most heavily regulated, you know, currency in the world. So why would they allow another one to circumvent it? That it kind of seems like a lot of these things were relatively transparent, or could have been foreseen early on, and probably going to end up being, you know, others benefit, you know, in various countries around the world. All right, I think we got time for maybe one more question. I don't know how long it is. People are closely watching the SEC lawsuit against Ripple. Does anyone have a view on what will happen to the market in general if the SEC is successful and or not successful with the lawsuit? I mean, it obviously seems like it's a very large binary event, but so I imagine there's a large discussion on it. But is it so extreme that it could cripple or kill the industry versus, you know, how much benefit does it do if they can't or not successful? Tough question. Probably not allowed to necessarily answer. I think either for some of us.
Yeah, look, it's very difficult to comment on you know, regulatory action and what the impact is likely to be. I mean, I think the SEC has a pretty clear framework. Not I think, the SEC has a pretty clear framework for determining what is a security and what is not. It's the Howey test, right? And it's open to a lot of interpretation. And you know, it's a very thorough process that exchanges go through, for example, when deciding whether to list something or not, and a scoring process. So like, I don't think that, you know, there are many cryptocurrencies that are very clearly cryptocurrencies according to that test, and you know, would not be subject to this. So I don't think it you know, it kills the industry, because it would just be a determination that it's a security, not a cryptocurrency. But it may cause people to have to be a little bit more precise in how they construct product.
Got it. That makes a lot of sense. Well, all right. I hope everyone was able to obtain some information and get a lot out of our you know, out of our webinar here. So I want to thank our outstanding speakers and to all of you for attending today's webinar. You will receive a follow-up email, which will include a replay of the webinar, information about our panelists, and a follow-up to any of the questions that you may have submitted that we did not cover. So please look out for that, and we look forward to seeing you again. And have a great day. Thanks, everybody.
Thanks,
Thank you.
Thanks, guys.
Thank you.
yeah, guys, good to see you.
All right, Mitch, I think we're stopped, right? Maybe. All right, I don't know. Thanks, Kevin. Thanks, everybody.